Welcome to the Technical Report, BF Anderson Technical Report for April 21st. Let's get right into the charts. These are the indexes that I think are important right now. The NASDAQ is showing a consolidation period. However, this is the strongest index of the indexes that I'm looking at, simply because it has held the 50-day moving average. The 25-day moving average continues to stay above the 50, and the index price is above both moving averages and is looking to break out. In fact, it's very close to making a new high. NASDAQ is the strongest index. Now let's look at some more. Here's the mid-cap index. You can see, that the 25-day is below the 50-day. However, we're seeing an improvement as of yesterday. Mid-caps need some improvement. Big improvement needed in the New York Stock Exchange Composite. This is mainly going to be banks, financial services, oil stocks. These groups have been underperforming, so this index is looking really the weakest. Now, on the New York Stock Exchange new lows, we're seeing a big improvement there. We want to see less than 40 a day. You can see here back in March, we got quite a bit of a spike. Actually had one day where we had 110 new lows. This indicator is most valuable when you're at a market top and you're concerned about a correction, because if you start to see more than 40 a day while the market's making new highs, they call it the leaky boat syndrome. It's kind of like the underlying market is not as strong as you would think. So right now, though, we're seeing much improvement in the number of new lows. Now, as we get into small cap indexes, again, you can see the underperformance. The 25 is below the 50. However, we got a big improvement in this index yesterday, mainly on discussions by Treasury Secretary Mnuchin, who is saying that the Trump administration is moving forward with a very aggressive tax plan. We'll talk more about that later in the video. Now, here's the S&P 500. Again, you can see the consolidation period here has been somewhat weak but improving. Now, going back in time a little bit, let's go back to 1980 again, just kind of rehash this a little bit. Wonderful bull market, big correction in the middle of it, which was the crash of 87. It occurred very quickly, though. It was October drop. One day, market dropped approximately 30% in one day, but then we started the recovery process almost right away. Whereas back here, if you look at this consolidation period here, it really has been very sluggish. This was about a 3-year period here that the market did nothing more than move sideways, and now is starting to break out. So the question is, and the theory is, that this breakout here resembles this breakout here, or it could resemble this breakout here, and this is somewhat of an 87. So trying to make a comparison here that I think makes sense. Now, what makes sense about this is this. Monetary policy, which is the Federal Reserve, is used to put a Band-Aid on the economy. It's basically used to keep the banking system viable and to also protect the currency. The last thing you want is for people to no longer view the dollar as worth anything. It's kind of a faith thing, as we all know, but this goes back in time for many years. So what happened here was Reagan came in, also Margaret Thatcher came in Europe, and started to make some very big changes. And the big changes were, we're going to stop the monetary policy. In other words, we don't need to put a Band-Aid on the economy anymore. The economy's fine. What we want to do now is we want to go to growth. And so fiscal policy kicks in, is the bottom line. And we don't want to underestimate the power of tax cuts, because this is what was the primary driver of this bull market, I believe, under Reagan, and then it continued all the way up. So realize we broke out at 1,000, and we really didn't peak till about 11,000. So we went up quite a bit. Now, are we going to have a similar bull market here? Well, I'm certainly hoping for that. Now, there is one short-term negative that I'm somewhat concerned about. Interest rates are starting to drop again. This is the 10-year Treasury note. The range had been between 2.3 and 2.6%. Well, recently it's broken down. It's currently around 2.2 as of this morning. It's at 2.23. So interest rates have kind of dropped back a little bit, which tells me maybe the market's discounting a slowdown of some sort. Now, if we get the tax cuts or talk of the tax cuts, that may change that. Now, again, back to the 1983 resemblance. The big resemblance was it's starting in 1998. Things changed. The economy just two bear markets. I mean, what else can you say? And this bear market here coincided with the worst recession we've had since, well, it was even worse than 74. I would say this is the worst recession since the 1929 Depression. So the problem for growth investors has been that the recovery has been incredibly slow, whereas in the past, especially back in 1957, the recovery was quite dramatic. So one thing about corrections that we have to think about is that corrections are very deceptive. They usually come in about three legs, and the first leg is the market makes a high, and then things start to cool off a little bit. Nobody really notices it, and then the second leg would be where the market drops a little bit more, gets down below the 50-day moving average, and people are starting to really kind of pay attention to it. And usually the third leg is some type of catastrophic drop. When I say catastrophic, I mean like 2 or 3%, or it could even be 8 to 10%, something like that, where there's some type of event tied to it. It could be North Korea. It could be anything. I mean, we don't know. They kind of call it a black swan event. So usually a correction, just be aware of it. It starts out slow, picks up steam, get the panic sell-off. Usually the correction is over at that point. Now, one of the reasons why I think the correction may be over is that the flows into mutual funds right now, the bond funds are getting a ton of money, whereas the stock funds are losing money. So that kind of tells me that, maybe the sentiment is swinging our way. Now, I did want to mention one last thing, and this is real important, and I hope everybody can follow me on this. This is a graph of the earnings of the Standard & Poor's 500. Now, when corporate earnings are increasing, where there's growth, the stock market does incredibly well. So if you go back and look at where we picked up steam back here in 2013, our portfolios had a very good year that year. It was one of our best years ever, in fact. Now, unfortunately, in 2014, the wheels started to come off the economy. Things just started to slow down again. Now, I do believe that the market discounts earnings about 6 months in advance. So we started to see really a slowdown in earnings for most of 14. Now, we had the first quarter was really pretty good, but then the wheels came off, started to move sideways. I believe the market was discounting this for 15, and basically in 2015 earnings peaked and then plummeted. We're talking oil stocks, oil company prices, the price of oil plummeting. That was a big drag on earnings, and as you can see, we really didn't have a very good year. It's very difficult in a growth stock strategy where you're saying, okay, I want to invest in companies that are going to be growing their earnings into the future, which to me is the only thing that makes sense. I mean, it's what drives the stock market. If you look at the correlation between corporate earnings and the stock market, it's almost direct. Now, during this period, though, what was really frustrating was things like toothpaste stocks, utilities, very, very defensive, what you would call risk-off type of investments dominated. So, those types of stocks dominate the indexes. So everybody goes, oh, gee, I need to do index funds. Look, if the economy turns, which it looks like it's doing, all that goes away, and the growth stocks come back into favor, because if you look at where we are right now, we're having a pretty good year so far this year. We're up almost 11%. Now, last year was another bad year. Corporate earnings did not start to improve until about November, December of last year, which happened to coincide with the election, so everybody calls it the Trump rally. Well, it's coincidental. I'm just telling you, the fact that earnings have turned up. This is a natural flow and ebb. This is the business cycle. I refer to this as an earnings cycle. So growth stocks are going to have a tough time in a down earnings cycle, but once the cycle reverses and turns up, back to the party. Give me a call if you have any questions. Thank you.